The silence surrounding the global financial architecture is deafening, yet the numbers vibrating beneath the surface are nothing short of cataclysmic. While the mainstream headlines divert your attention toward trivial cultural distractions and geopolitical skirmishes, a silent $4 trillion evaporation has occurred within the bedrock of the banking sector. This is not merely a statistical anomaly or a temporary dip in quarterly earnings. It is a structural fracture in the foundation of the global economy that experts are desperate to keep under wraps. To understand why $4 trillion simply vanished into the ether, we must peel back the layers of a system that has been operating on borrowed time and artificial buoyancy for over a decade. We are looking at a masterclass in financial obfuscation, where the traditional rules of capital preservation have been discarded in favor of a high-stakes gamble that is now coming due. The narrative being sold to the public is one of resilience and regulatory strength. Yet the reality behind the balance sheets suggests a terrifying fragility that could unravel the very fabric of our modern monetary existence. Imagine a machine that has been running on the fumes of endless liquidity, only to realize that the fuel line has been severed, and the engine is now consuming its own internal components to stay alive. This is the story of the $4 trillion that disappeared, and why the architects of this system are terrified that you might finally start asking the right questions. The decline began with a fundamental miscalculation regarding interest rates. For years, banks were encouraged to park their excess capital in long-term government bonds, which were considered the safest asset class in the known world. It was a strategy based on the assumption of permanent low-interest environments, a policy nurtured by central banks that essentially guaranteed that the cost of borrowing would remain near zero. But then the tide shifted. Inflation, once dismissed as a transitory ghost, erupted with a ferocity that forced central banks to pivot aggressively. As interest rates soared to combat the inflationary surge, the value of those long-term bonds, which had been locked into low yields, plummeted. This is the simple mathematics of the bond market. As rates climb, prices fall. Banks suddenly found themselves holding trillions of dollars in assets that were worth significantly less than what they paid for them. However, because these assets were classified as held to maturity, banks were not required to mark them to market. They were effectively hiding the rot in plain sight, pretending that the hole in their ledger did not exist. This is the first layer of the deception. It is a game of accounting make-believe that allows institutions to appear solvent while their actual net worth is being hollowed out by the very policies designed to keep the system afloat. But the rot goes deeper than mere bond valuations. We must consider the commercial real estate sector, a looming titan of debt that is currently teetering on the edge of a systemic collapse. With the shift toward remote and hybrid working models, the demand for traditional office space has been fundamentally altered. Buildings that were once the crown jewels of investment portfolios are now becoming stranded assets, empty husks that generate no revenue but carry massive debt obligations. Banks are the primary lenders for these properties, and as the value of commercial real estate continues to erode, the collateral backing these massive loans is evaporating. We are witnessing a slow-motion car crash where the impact is being muffled by bureaucratic layers of restructuring and loan extensions, but the physics of the situation remain unchanged. When a bank lends money for an office tower that is now worth 40% less than it was 3 years ago, that loss is not theoretical. It is a hard reality waiting to be realized. The $4 trillion in losses are not just numbers on a screen. They represent the erosion of trust, the depletion of reserves, and the weakening of the global banking system's ability to facilitate trade and growth. Why is nobody talking about this? Because the admission of such a massive loss would trigger a crisis of confidence that the current financial order cannot survive. If the public truly understood that the institutions holding their deposits were functionally insolvent, the resulting bank runs would be instantaneous and uncontrollable. The system relies on the illusion of stability to prevent the reality of panic. We have been conditioned to believe that central banks are the ultimate backstops, the lenders of last resort that can print their way out of any predicament. But printing money is not a panacea. It is a tax on the future, a dilution of purchasing power that further exacerbates the inflationary pressures that cause the interest rate hikes in the first place. It is a vicious cycle of interventionism where every solution creates a new, more dangerous problem. The $4 trillion that vanished are the collateral damage of a system that prioritized short-term expansion over long-term stability. The complexity of the modern financial system is designed to obfuscate accountability. When a bank fails, it is rarely a single event. It is a cascade of interconnected failures where a counterparty risk spreads like a contagion through the global network. We saw a preview of this with the regional banking turmoil that occurred, but that was merely a ripple compared to the tsunami that is currently building in the deep ocean of international finance. The shadow banking sector, a massive and largely unregulated ecosystem of non-bank financial intermediaries, is also heavily exposed to these losses. These entities operate outside the purview of traditional regulators, yet they hold trillions in debt that is intricately tied to the same commercial real estate and bond markets that are currently under siege. The interconnectedness of these entities means that a failure in one corner of the market can trigger a chain reaction that engulfs the entire global economy. This is why the silence is so carefully maintained. The gatekeepers of the financial world are terrified of the domino effect. They know that once the narrative of stability is broken, there is no mechanism to restore it. We are living in a state of suspended animation, waiting for the next catalyst to force the truth into the light. Consider the role of the derivative markets, where trillions of dollars in notional value are tied to interest rate bets. These instruments were designed to mitigate risk, but in the hands of desperate institutions, they have become mechanisms for extreme leverage. When the market moves against these bets, the margin calls are relentless, forcing banks to liquidate other assets just to stay afloat, which in turn drives down prices further and triggers even more liquidation. It is a self-reinforcing downward spiral that the regulators are struggling to contain. The $4 trillion loss is the culmination of years of cheap credit, reckless risk-taking, and the absolute refusal of policymakers to let market forces dictate the reality of valuation. We are paying the price for a decade of financial engineering that treated the laws of economics as mere suggestions. The tragedy is that the burden of these losses will inevitably fall on the average individual through a combination of inflation, stagnant wages, and the slow erosion of savings. The hidden cost of this systemic failure is being distributed across the population. It is a silent tax that is rarely discussed in the context of the banking crisis, yet it is the most visceral impact for the common person. The preservation of the banking sector has become the primary objective of the state, even at the expense of the currency's value and the public's standard of living. As we look ahead, the question is not whether the system will face a reckoning, but when that reckoning will reach a point of no return. The current strategy of buying time is reaching its limit. There are only so many ways to kick the can down the road before you run out of road entirely. The $4 trillion is the manifest evidence that the strategy has failed. We are seeing the cracks widen in the facade of the global financial monolith, and the attempts to patch them are becoming increasingly desperate. From the massive liquidity injections to the clandestine bailouts disguised as regulatory support, the pattern is consistent. Protect the institutions at all costs, even if it means sacrificing the long-term health of the economy. But what happens when the institutions no longer have the capacity to protect themselves? What happens when the public realizes that the safety net is a mirage? The psychological shift in the market is often the final piece of the puzzle. Once the realization sets in that the system is fundamentally broken, the flight to hard assets and alternative stores of value becomes a stampede. We are already seeing the precursors of this behavior with record levels of interest in gold, silver, and decentralized financial technologies. The market is trying to tell us something, But the narrative controllers are working overtime to suppress the signal. They use technical jargon to confuse the issues. They point to minor improvements in economic data to suggest a recovery is underway, and they label anyone who questions the status quo as a fearmonger. But fear is a rational response to an irrational situation. Ignoring the disappearance of $4 trillion is not an act of optimism. It is an act of profound denial. Let us examine the history of such crises. Every major financial collapse in the last century was preceded by a period of extreme denial, where authorities insisted that the fundamentals were strong and that the risks were contained. The 1929 crash, the 2008 financial crisis, the Japanese bubble of the 1990s, all were characterized by a collective refusal to acknowledge the inevitable. The current situation shares the same DNA. The scale of the assets involved is significantly larger, and the global integration of the financial system means that the impact will be far more widespread. We are witnessing the end of an era of monetary expansion that began in the wake of the 2008 crisis. That era was defined by the belief that central banks could manage the economy with surgical precision. The reality has proven to be quite different. They have created a monster of debt that they no longer have the tools to control. The $4 trillion is just the beginning of the adjustment. The true cost will be measured in the loss of faith in the monetary system itself. When the currency is no longer a reliable store of value, the entire social contract begins to fray. We are not just talking about bank failures, we are talking about the potential for a fundamental reconfiguration of how wealth is held and transferred globally. Many believe that we are heading toward a digital currency transition, a move that would grant central banks unprecedented control over every transaction, effectively eliminating the privacy and autonomy that are the hallmarks of a free society. This would be the ultimate solution for the authorities, a system where they can dictate the velocity of money, impose negative interest rates directly on the public, and track every cent of economic activity. The $4 trillion loss is the perfect justification for such a transition. By creating a crisis, they provide the solution that leads to even greater centralization. It is a classic Hegelian dialectic: problem, reaction, solution. They create the problem, wait for the public reaction of fear and instability, and then introduce the solution that they had planned all along. The question is whether the public will accept this new order or if there will be a significant pushback against the encroachment on financial freedom. The stakes could not be higher. If the banking system is allowed to continue its current trajectory, the path leads to a total loss of economic sovereignty for the average citizen. We must understand the mechanics of this shift to recognize when it is happening. Keep an eye on the liquidity metrics, watch the bond yields, and pay attention to the rhetoric coming out of the major financial institutions. When the language shifts from stability to the need for a great reset or a new monetary framework, you will know that the transition has begun. The $4 trillion is the signal that the old system is dying. It is an undeniable fact that the banks have lost this capital, and no amount of institutional spin can change the reality of the balance sheet. The silence is not an accident. It is a tactical choice to prevent the realization of how fragile the entire construct truly is. But silence cannot stop the laws of economics. The debt must be reconciled, the losses must be accounted for, and the illusion must eventually shatter. We are at a crossroads where the decisions made by a few will affect the lives of billions. The responsibility lies with us to stay informed, to look beyond the headlines, and to understand the forces that are shaping our future. The mainstream media may keep quiet, but the truth is written in the data, if only you know where to look. We must continue to peel back these layers, to expose the mechanisms of control, and to prepare for the inevitable shift that is coming. The $4 trillion is not just a loss, it is a warning. It is a warning that the system is not as robust as it claims and that the risks are far greater than we are led to believe. As the tectonic plates of the global economy continue to shift, the pressure will only increase. We are entering a period of profound uncertainty, and those who are prepared will be the ones who survive the transition. Do not let the silence distract you from the reality of the situation. The numbers do not lie, and the math is catching up with the architects of this systemic failure. The question is no longer whether we will face a crisis, but what that crisis will look like and how we will navigate the fallout. History shows us that those who understand the nature of the crisis are the ones who can protect their interests and emerge on the other side. Do not be a passive observer of your own economic demise. Take the time to analyze the data, question the narrative, and understand the implications of what is happening behind the closed doors of the banking sector. The disappearance of $4 trillion is the most significant financial event of our lifetime, and it is only the first chapter in a much larger story. The system is designed to keep you in the dark, to ensure that you continue to participate in a cycle that is rigged against you. But knowledge is the ultimate weapon against this control. By understanding the mechanics of the banking collapse, you empower yourself to make better decisions and to protect your future. We are reaching a point where the traditional methods of wealth preservation will no longer be sufficient. We need a new understanding of the global financial landscape, one that acknowledges the reality of the risks and the necessity of independent action. The $4 trillion loss is the catalyst for this new understanding. It is a clarifier that strips away the pretenses and reveals the underlying weakness of the current order. We have been living in a dream world of infinite growth and zero risk, but the reality is now asserting itself. The era of the easy fix is coming to an end, and the era of accountability is beginning. This is a time for vigilance, for critical thinking, and for a commitment to the truth, regardless of how uncomfortable it may be. The silence around the $4 trillion is a deliberate attempt to manage the narrative, but the truth is already leaking out. The cracks are too large to hide, and the consequences are too severe to ignore. We must continue to push for transparency, to demand answers, and to prepare for the reality that the financial system as we know it is undergoing a fundamental transformation. This is not just about money, it is about the future of our society, the preservation of our liberties, and the ability to define our own economic destiny.